Welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Now, it's been a choppy ride for the market so far in 2016, and many of you may have been wondering if the current fall is actually a good opportunity to boost your equity portfolio. Well, we've been getting plenty of queries on mutual funds, so we've decided to dedicate this week's show to equity MFs as an investment avenue. Joining me on the show today is personal finance expert Harshvardhan Roongta. Harsh, thank you so much for coming in and taking all the questions. We've got plenty of questions coming your way. But before we get down to specific viewer queries, I want to, get some hygiene elements out of the way. The market has been very volatile. 2016 hasn't been good. But interestingly enough, domestic institutions, domestic fund houses have been consistently pumping in money. Perhaps it's a sign of, the change in investor psyche and sentiment. But what's your advice? I mean, are corrections like these a good time to be looking at additional funds or churning your equity portfolio?
Well, Surabhi, if you look at the nature of equity markets, it is apparent that they're supposed to be volatile. Now, if you want to create wealth over a longer period of time, you need to be into assets which are growth-oriented, not just returns-oriented. Like, you do not get fixed coupon rates. So, equity markets in that context are always going to be there. Yeah. You're going to get opportunities. Now, your question whether this is a good time to buy. Yes, in case you have the liquidity and you wish to invest into for long term, this is definitely a good opportunity to buy.
But then the definition of long term, and this is what a lot of viewers keep asking us, and how long is long term? I bought a stock and I let it be for 5 years. Look at it, and, it's come back to my acquisition price, sometimes even lower, because the person wasn't very quick enough to trade in and out or switch out when the profit was right. So therefore, if someone's looking at fresh equity purchases right now, then what sort of a basic time period should he or she look at?
Well, this is a very interesting question. The reason being, we talk about equities give you good returns over a longer period of time. Now, what does this mean? Does it mean that you buy one particular company, sit on it for like 10, 20 years? Do you think you will make money? It may not be so. The reason being, that company has its own dynamics to function. If you're buying any individual stock, which means that it works individually and that company could even be defunct the next day.
Sure.
So if the company has stopped functioning and you simply sit on it for another 10 years, you're not going to make money. When we talk about equities generating good returns over a longer period of time, it means that you create a basket of equities. This is where mutual funds come into picture. When you invest into a scheme, that scheme invariably has 30 or 40 companies that it invests into. Now, some of those companies that the fund manager has picked up may not do well. So if a company does not do well, or is there a particular time when they're supposed to trade off, as you mentioned, that they've not possibly bought it at the right time or sold at the right time. So that's the job of a fund manager.
Sure.
So out of those 30 or 40 companies, you will find that not all companies are held on for 20 years. But your mutual fund investments could be held for 20 years.
Sure.
And the changes that need to be made is done by the fund manager within those schemes.
Okay. Another basic. At this time, a lot of people might be thinking, the market has fallen. Do I put in my entire available, amount? Do I put in my whole corpus as a lump sum? Should I stagger it out as an SIP? What to do?
Well, now, if you can understand, if an investor understands the functioning of a market, if you can stomach the risk. What do I mean by stomach the risk? If you have a lakh of rupees to invest and you put that entire money in today, if the markets fall from here, you start incurring a loss on the entire 1 lakh. And if the market goes up from here, you start earning on the entire 1 lakh. So there is a high volatility if you look at it, in a lump sum investment. Now, if an individual is comfortable to bear that kind of risk and that volatility, then a lump sum is not a bad idea. So that you start getting the benefits of compounding. Now, an SIP in that context would give you a rupee cost averaging benefit. So compounding is going to be less, and averaging is going to be more in an SIP kind of a format. Now the combination that we're talking about, in a moderate risk profile, how do you take a moderate route? Maybe in a situation, you need to interact with the individual to come to an exact allocation. However, if he thinks that this is a good levels to invest into and economy looks good, especially India in that context, you could put a 50% as a lump sum and stagger the other 50%. Or in case you wish to be a little more conservative, you could invest a 25% in lump sum and a 75% over a period of time. Now that 75% could also be staggered. You could take a call on that as well. You want to invest into the market in 3 months, 6 months, 1 year, or even 2 years. So that combination is dependent on how individual would perceive the market and at what levels the current markets are.
So, okay, now we come down to the choices, and there are so many when you're trying to pick the right equity mutual fund. Again, and just to keep this, standardized for our viewers, we're talking about a medium risk portfolio for the next couple of questions here. Now, starting off with whether I should buy an index fund, and therefore that allows me to directly buy the Nifty or, the market as such, or should one be looking at large cap funds only right now, or is a diversified fund with which includes a little bit of mid-cap as well. What's the right way for a medium risk portfolio?
Well, Surbhi, when you construct a portfolio, diversification is the key. So what happens is you construct a portfolio with all capitalizations, all different sectors into one. What do I mean by when I say this? You would have exposure into large cap companies. There is some percentage you would also want to keep into mid caps. Why would you want to? Because you do not know, some mid caps will tomorrow become large caps.
Sure.
The question is, how much allocation would you give to large and mid caps? Now, if you talk about medium risk profile, as you said, we're looking and talking about an individual with a medium risk profile.
Right.
Ideally, your core portfolio should be into large caps, because these companies are established. They have, they have the cash flows, the balance sheets to weather any kind of economy, downturn. So a 60% portfolio investment should be into large cap companies. So this gives you some kind of a stability, and you invest into known and well established companies.
Okay.
30% could go into mid and small cap companies, because these have the potential to be the large caps tomorrow. Then the fund management skills come into play when they pick up which companies are they picking up, who are potential large caps, and you would want that kind of an alpha in your portfolio. A 10% that is left could be allocated towards a particular sector, in case an individual is comfortable and can track a particular sector, or he could look at diversifying this 10% out of the geographical locations. Now, by what I mean is that you can invest into, say, probably US markets. You could invest into another emerging economy if you want. So different countries altogether. So your money not only is invested in India, but also out of India into some other developed markets. So so we have specific international funds also available and offered by mutual fund, the asset management companies.
Okay, so basically we have a 60-30-10 sort of a breakup for a medium risk portfolio. We're going to take a very quick break. When we come back, we'll ask Harsh to help us identify some of the fund houses, some of the schemes that could go into this medium risk portfolio after the break.